why I'm going to record this webinar is because we are members of the Guelph District Association of Realtors. And for those of you who can't stay with us for the full 25 or 30 minutes, you will be able to pick it up on the GDAR intranet. So the role of the mortgage broker in preparing buyers for a no financing condition, our role is to ensure that the 4 C's of credit are intact so that the buyer can actually go ahead without a financing condition. So we do a credit check. We get their clients' credit bureau authorization. We do a credit check. We review their credit. The typical credit agency that's used for financing is Equifax, and they have a new scoring system, particularly for mortgage lending, and it's called a FICO score. And did you know that they have recently changed their adjudication? And if somebody is looking for a mortgage and have multiple credit checks within a 45-day period, it's only counted as one credit hit. So the role of a mortgage broker is to make sure that there are no issues when the client goes forward and puts an offer. And how we do that is we pull their credit history. We have a direct connection with Equifax Canada. We verify their income. So sometimes buyers drag their feet on income documents. And it is really a disservice to not only the person who's buying the property, it's also a disservice for you as a realtor, because you don't want to be wasting time with buyers who are not financially organized. And I know sometimes people have, issues with collecting documents. You want to make sure that we talk to our buyers all the time and say, these are the documents that we need. And we have sometimes people drag their feet, but it's our job to wrestle them down and get those documents. For T4 employees, it's not a big deal. Usually we need T4s for the last 2 years, 2 recent pay stubs, and a letter of employment verifying that they are working and they are full-time. For self-employed people, it's a bit tricky, and it requires more documentation. And so what we find is that 95% of the self-employed people are organized and have their finances together. The 5% are the people that don't. And those are the people who are going to have trouble with purchasing a property. So the role of the mortgage broker, in our opinion, is to verify credit, verify income, and then verify down payment. And the way that down payment is verified is 3 months worth of bank statements. That is considered the borrower's income. That is considered the borrower's savings. Once they've had like 3 months worth of the money in their account for 3 months. If they are getting a gift, we do get a gift letter. So we also, the role of the mortgage broker is to make sure that we underwrite the files. So we check debt ratios, the total debt and gross debt service ratio. Now, just like your business with real estate agents, when the market is as it is, there are hundreds of people that are getting in the market who may not have the ability to not only do the right things for the borrower, like a credit check, income verification. They may not actually know how to underwrite a mortgage because it is quite a complicated thing. And there's so many different financial institutions that have different requirements. So make sure that when your clients are getting pre-approved, that they are getting pre-approved not only with a reputable organization, somebody who actually knows how to underwrite and verify the debt ratios are in line. The role of a real estate agent, on the other hand, and this is how we see it, is to help and work in partnership with the mortgage broker to ensure that there's not going to be any issues with the collateral. So when we do a mortgage pre-approval, we verify, and remember guys, the 5 C's of credit. I know this is mortgage financing 101, but some of you may have taken this a long time. So there are 5 C's of credit. There's capital, which is a down payment, credit history, we talked about that, capacity, which is a debt ratios, character, which is the job stability, and the last C of credit is collateral. And that's your role as a realtor to help us with verifying that the collateral or the property that the person is buying is there's not going to be any issues with that. And we have this really great tool, and I'm going to just do a stop share here. We have this really great tool at our office called Purview. And we normally would run a Purview report once we get the MLS from the realtor on the property that the buyers are putting an offer on. And so once we get, your role as a realtor would be to email us a copy of the MLS with the seller's name on it and to do a comparative market analysis on the property, a CMA. We run what's called a Purview report, and it's a report that's generated through Terranet, and it gives us an idea of what the value of the property might be should an appraisal be required. So again, the role of the realtor is, we see it, to work in partnership with the mortgage broker. We verify the client's 4 C's of credit. You help us with the 5 C of credit. Because if there will be issues, because that's something that we can't verify until we actually have a property in mind, and that buyer is ready to purchase the property. So again, the role of the realtor would be to send us the MLS with the seller's name on it, do a comparative market analysis. We marry that with the Purview report, and we can see if there's going to be any issues with the valuation on the property. So the majority of buyers that we work with have 20% down or more. However, I'd say probably 25% of the first-time home buyers we work with have less than 20% down. And they do not have a lot of wiggle room should the valuation on a property come in less to make up the difference. So that's it's a bit trickier dealing with a first-time home buyer who has less than 20% down going in without a financing condition. But for the majority of the buyers that we're working with, and probably you're working with, they have 20% down or more, which gives them a little bit more flexibility if the valuation on the property comes in low. And in normal times, what we used to do is we used to pre-approve people. They put an offer on a property, and then the financing condition would be the period of time where we actually verified the collateral. And of course, that is not an option anymore. For those of you realtors who are working with first-time home buyers who are putting offers together where borrowers are putting less than 20% down or more, putting less than 20% down, CMHC, Sagan, and the other default, Canada Guarantee, the other default insurance providers actually have an auto valuation system. So in most cases, when you have less than 20% down, the property doesn't have to be appraised. But if it's more of a rural area or a unique property, or the valuation is not deemed acceptable to the default insurance providers, there will be an appraisal done. And that's obviously not the, if CMHC requires an appraisal on the property, it's not the borrower who's going to pay. Anyway, so that is what the role of a realtor is in preparing a buyer for a no financing condition, is really to work with the mortgage professional to make sure that there's not going to be any issues with the collateral. Some of the common questions we have from buyers is, if I don't have a cash offer, how can I put an offer on a property without a financing condition? And I also have many questions, is my bank requires it? What are the risks? Well, and I think people, buyers don't realize oftentimes that the contract that they're signing, the purchase agreement that they're signing, is a legal contract. And if they cannot fulfill that obligation to purchase the property, there will be some legal ramifications around that. Pre-approval certificates versus pre-qualified certificates, and there is so much information online. Anyone can get a pre-qualification certificate, and actually what I'll do is in the chat here, I'll if you guys want, I just sent you guys a link to a pre-qualification certificate that we have. And people can just download our mortgage app. It's excellent. You as a realtor should download it because you can run some different scenarios for people. You can check mortgage payments. You can even check interest rates. But a pre-qualification certificate just kind of gives people an estimate on what they can afford. And what I find is that most individuals overestimate their income and underestimate their debt. So, although a pre-qualification certificate is a good idea, it gives people just sort of a general idea of what they can qualify for. When they come to our office, we actually issue a pre-approval certificate where we verify that credit, we verify the income, and we verify the down payment. Now, one of the common questions I do get from people who are getting pre-approved is how long is my pre-approval good for? And I think what they're asking for is, how long can I hold the interest rate for? Because rates are going up. And I probably won't be buying a house in 4 months. When do I need to come back to you to update my pre-approval? So rate hold periods vary from institution to institution. As a mortgage broker, we do mortgages for most banks like TD and Scotia, and we also have access to wholesale banks and credit unions. So every financial institution has a different rate hold period. They, again, are typically somewhere between 30 and 120 days. Again, 4 months is ideal, especially now in an environment where interest rates are going up. However, what I tell most people is that if there are no material changes to your mortgage application, that mortgage pre-approval is good for as long as there are no material changes. And when I say material changes, I mean any changes to credit history, income, and also to any of the liabilities that you would have. So to answer your question on the rate hold period, the rate hold period is a good way to hold an interest rate. Typically, it's somewhere between 30 and 120 days, depending on the institution. But if there are no significant material changes, like you've changed your employment or something has happened with your credit history, that mortgage pre-approval is good for an indefinite period of time. Now, one of the things that can happen, which has happened, is legislative changes may affect your mortgage pre-approval. So all of our pre-approvals that we've done, we kind of keep people, we stay in touch with people. We update their mortgage pre-approvals. And then if they want to just do another rate lock, we can do that for them. So can a person who already owns a home be declined for a mortgage on their next purchase? And I'm actually the people that I talked to on Monday or yesterday, they actually owned a house that had a mortgage and now they can't get approved for their next purchase. And the reason why that happens, common reasons for a decline by an existing lender, well, they are related to credit history. Some, like if someone, for example, I had a buyer, somebody that I was talking to yesterday, they had lost their job during COVID. They're back to work full time right now, but missed a mortgage payment. Changes to employment, if people have recently changed jobs, that might affect the fact that they are now declined even though they own a house and already have a mortgage. Many people have gone from working as a T4 employee to now being a subcontractor for that company that's considered self-employed. Sometimes banks will decline a perfectly good file if there is no sale of home condition in their purchase agreement. And then in other instances, there could be an issue with the property that they're purchasing. So one of the things that comes up, and I get this question all the time, is, my bank has declined me. I have a $300,000 mortgage with RBC. They now have declined me but I only want a $300,000 mortgage, or I only want a $250,000 mortgage on my next house. How come they decline me? So even if you are going to port that mortgage or take that mortgage from one house to another, you have to requalify, even if it's less. So whenever the change happens in the collateral or the home, the person who is borrowing the money has to requalify. So these are some of the reasons that come up. So if you are a seller's agent, these are some of the tips for you in detecting unqualified buyers and questions you should be asked the buyer's agent. Okay. And, what's the down payment? So if I was a seller's agent, I'd be saying, yes, we're going to accept your offer, but I do have a couple questions that I'd like to ask, because a pre-approval certificate these days really isn't, really is only worth the paper that it's written on. So what's the down payment? You would know that if somebody has 20% down or more, the likelihood of them not qualifying for a mortgage is a lot less than if the buyers have less than 20% down. It's just they have a little bit more wiggle room. The other question I would ask is, do you know if an appraisal would be required? I can tell you in the majority of cases, when somebody is purchasing a house and they have more than 20% down, and it's not a cookie cutter house, an appraisal would be required. And remember, if the appraised value is significantly less than the purchase price, issues with financing can come up, and the buyers will have to have a good plan B if there's a low appraised value. Another question I'd be asking if I was a seller's agent is, what is their employment status? If they are self-employed, that may pose some challenges with financing. And then I said the paper, the pre-approval certificate is not the paper it's written on. The pre-approval certificate is actually a really good tool, because it should say on the pre-approval certificate whether an appraisal would be required, what the down payment would be. So for example, if you've got a pre-approval certificate for $1 million and the people have 500,000 down as a down payment, that's probably a very good indication that these people will not have any issues with financing. However, if they're buying $1 million property and they only have $100,000 as a down payment, that might be an issue, right? So here are some other questions that I would be asking borrowers, alike, if whether or not you're a seller's agent or a buyer's agent. So if I was a buyer's agent and I was, trying to verify whether these clients were qualified buyers, and if I always recommend when I do a mortgage pre-approval with somebody, regardless if they are buying their first house or buying their third house, I always ask them to be put in touch with the real estate agent, and if I can share their financial information with their realtor. So some of the things that I might be asking as a realtor is, did you have any CERB income in the last couple of years? Did you provide letters of employment and matching pay stubs to your mortgage broker? Lenders will actually call within a week of closing to confirm income. So I have had a few instances where people didn't tell me that they were going on maternity leave, and then the lender called and was trying to verify income for the people who are buying, and the borrowers and the employer said, "Oh, well, she's on a maternity leave." That's okay. Maternity leave is fine. We can use their back to work income to verify the mortgage. The issue is that we haven't been upfront with the lenders. So the lenders will call within a week of closing to confirm somebody's income. So if they've changed jobs and think that they're going to kind of slide it under the door, it's going to be a problem. And it has, because I get those calls. And then for those people, for those of your clients who are self-employed, who don't have their taxes completed yet for 2021 or seem disorganized or often brag about what they make, I find those are sometimes red flags. Um, the other question I would ask as a realtor is, when and how did you get your pre-approved for a mortgage? Was it just a was it a pre-qualification certificate or an auto pre-approval from one of the thousands of websites that are out there? Um, as I said, we always ask for an email introduction to the realtor that the clients are working with, just because we're going to need the MLS from you with the seller's name on it and work together to make sure that there's not going to be any issues with the appraisal. There are also changes to the pre-approval criteria. Obviously, there is that stress test rate that's in place right now, but right now, the 5-year fixed rate mortgage is just over 4%. And how the stress test works is it's based on 5.25% or the contract rate plus 2. So if the contract rate right now on a mortgage is 4%, for the stress test rate would be 4, 5, 6%, right? So that might impact people's mortgage pre-approvals. And also you might ask, have there been any recent changes to employment? We deal with a lot of people just recently within the last year who have changed employers. And that's okay. Because if, for example, the person's an engineer or a nurse or an accountant or in some sort of professional job, and they've just recently changed employment, we can, and they're on probation, we can still use their income if they're working in the same industry. But understanding, we always ask, have you changed employment? Because we get mortgage applications before we meet with clients. But this is something that you may want to ask. And I don't think it's too prying. The other thing that we're very careful about, especially for offers that have no conditions, is have you talked to your mortgage professional about a plan B in case there's a low appraised value? Mortgage verification is becoming an important step for realtors, even as prices rise, because we're actually doing more and more alternative loans and more private mortgages. So not only do people have first mortgages registered on the property, they may have a second mortgage or a lien from CRA, or they may have some sort of lien against their property that's related to a business. Obviously, first-time home buyers are impacted more by a low appraised value if they have less than 20% down. And sometimes it's not a low appraised value. Sometimes it's the condition of the property or the location that's an issue. And I can tell you we have had very few issues with low appraised values. Just within the last couple of years, I can count them on a hand. But when the appraisal does come back low, if it does, we always have a good backup plan for the people who are buying. The other questions you might ask, and this especially if you're working as a seller's agent, is do the sellers understand how bridge financing works? And this is one of the most misunderstood concepts for mortgage financing, because the bridge loan is a loan for the down payment if your purchase and your sale dates don't match. So for example, a bridge loan, let's just say somebody is purchasing a house and it's closing on May the 1st, but their sale is not closing until June the 1st. They have a legal contract that says that they're going to be selling their house on June the 1st, but they don't have that money yet. So the bridge loan is a loan for the down payment, and it is only possible if you have a firm offer on both your sale and your purchase. What happens if you're helping an out-of-town buyer who has a home to sell in another city? Obviously, you guys are really great realtors. You're here today. You're learning. You want to make sure that you contact the agent who's selling the house in the other community to make sure that you understand what kind of house they are selling and how long it's going to take. I mean, I don't have to tell you to do your job. I think this is common sense. But what we're also finding is that many of our buyers are deciding to keep their homes, converting it into a rental property, and then using that equity to buy their next house. So sometimes you might have a buyer who owns a house who doesn't need to sell their house, which is a very unique and position and a power position to be in if you're dealing with those buyers. And then we are also working with many people who are downsizing who may not need to sell their house first, where we do a private bridge loan for them so that they can move into their new condo or their smaller house, um, and then put their house on the market after they've moved into their new home. So just to wrap things up, these are some of my recommendations for preparing your clients, whether or not they're first-time buyers or even sellers. Obviously, get them pre-approved no matter what. Prepare them to have their documents up front, because that is the first thing that we're going to ask them. And understand, and we always go through people who are buying and selling, making sure that they understand how bridge financing works. Now, I just wanted to wrap up and tell you about a unique product that we've been offering that has helped many people. And it's with a company called Canada Mortgage Lending Solutions, or CMLS. Avio, it's their alternative division. And this is the special product that is excellent for borrowers who have 20% down or more, have good credit, but need a higher pre-approval amount to get into the right home. And the reason why this is such a great product is, we had talked about that stress test rate. That stress test rate of 5.25, or the contract rate +2, whatever's greater, really limits what people can get pre-approved for. And this particular product, it's kind of like a credit union product where there is no stress test. So let's just say if the interest rate on a 5-year fixed is 4.25, that's the actual rate that you can qualify people on. So what it does is it opens things up to allow people, if they were thinking that they're going to need a cosigner, they no longer need a cosigner, or helps them maybe get from that 2-bedroom condo into a townhouse. So again, a really unique product offering. We've had some really great luck, and I thought I would share this with you. It is specially designed for borrowers who have the 20% down or more and are just having an issue getting into that pre-approval amount to either, buy something that's like a detached house, or maybe instead of purchasing a 1 or 2-bedroom condo, you can get them into a townhouse. We love working with realtors. You can always email me any questions that you have, give me a call, or you can go to my website. The website is skipthebank.ca, and you can book an appointment. And we love hearing from you. If you enjoyed working with us or enjoyed this webinar, just Google the Mortgage Center Guelph, and please do a review. I'll keep my eyes out for that review and respond. So you guys have a good day. If you do have any questions, you could just certainly email me, and good luck. Go sell a house. Okay. Have a nice afternoon.